By the time that I was 30, I'd built a 6-figure investment portfolio, and today I wanted to share with you the 21 investing tips that helped me achieve this. Whether you're just starting out or if you've already got money invested, at least one of these tips will change how you think about investing your money. No BS, no fluff. Let's begin with tip number 1, which is the first £10,000 is the most important. Reaching a 10k portfolio is a pure slog. But if you're investing like £500 a month for the 7% rate of return, it'll take you about 18 months to get there. But here's the cold hard truth. Up until that point, your contributions did 95% of the work, and the market only gave you a pittance of 5% in growth. At this point, some will obviously quit because it feels like you're almost on an investing treadmill, if you like, where you're putting in lots and lots of effort for very little return. People think, well, if it's going to take me 1.5 years just to get to £10,000, well, it's going to take me another 15 years to get to £100,000, and that's just simply too long. But they would be wrong, because after £10,000, something called compounding starts to kick in. Each £10,000 milestone gets quicker to achieve, and by the time that you reach a £100,000 portfolio, actually the market has provided 36% of your portfolio's value. And it's only going to take you 9.5 years. The first £10,000 is a total test of your character, but every pound after that is a reward for your discipline. Paying high fees is like investing with a hole in your Tupperware, yet most investors don't realise it until it's too late. And I hope this Tupperware isn't my wife's favourite, otherwise I'm in trouble. Anyway, research from Vanguard shows that if you have a £50,000 investment portfolio, after 30 years, it would be worth £214,000 if you paid 0.5% in fees. Pay just 1.5% more and you can say goodbye to 36.5% of the value of your portfolio. Even the FCA, the UK's financial regulator, has been quoted saying that just a 1% annual charge could slice the value of a pension pot by a quarter. So make sure you're aware of fees like account fees, transaction fees, ongoing charge figures, along with FX fees, as these can all unintentionally eat into your long-term investment returns. And I'll share with you a low-cost broker in just a moment's time. Tip number 3 is to have a 5-year no-go zone. Investing is for long-term growth and not short-term cash. If you need that money for, say, a house deposit, a wedding, perhaps even just to pay your bills next month, then it's probably not sensible to invest that money. And here's why. Since 1969, the global stock market has returned 10.3% per year on average. This chart is what entices people to invest short-term money. But what most fail to realise is that this is also the monthly drawdown across this 57-year data set. A 5% drawdown is extremely common, but being down 40 to 50% is also possible. What you have to ask yourself is, if my portfolio is down 20, 30 or 40%, would it affect my ability to pay for short-term expenses? And if the answer is yes, well, you've been warned. Tip number 4 is human capital is greater than portfolio capital. I first started working life here at McDonald's, earning £4.35 an hour. It worked out to be a part-time wage of about £6,500 a year, and I couldn't afford to invest a penny back then. However, once I was able to secure a graduate job earning £28,000 per year, everything changed for me, and I was able to make my first £400 investment. The reason why I tell you this is because Nobel Prize winner Gary Becker proved that in his academic paper called Human Capital, that for young people, your ability to earn is your most valuable asset. And that certainly resonates with me. I went from the drive-thru at McDonald's to a banking job to running my own business. And each jump provided me with more money than the stock market ever could have done during the short term. Because if I think about it in the context of my ability to scale, well, a 10% return on a £1,000 portfolio, which would have been really hard for me to save back in the day, would have only been £100. But just by getting a new job, well, that gave me a 330% ability to increase the amount that I could invest each month. And whilst there's certainly no amount too small to get started investing, having a higher earning potential will give you such an advantage when you're starting out. Tip number 5 is don't pay taxes. I'm not talking about anything illegal here. In actual fact, it's a perfectly legal tax-free loophole, if you like, and it's called the Stocks and Shares ISA. You can invest up to £20,000 per tax year here, and any capital gains or dividends that you receive are totally free from tax. This is admittedly the closest thing you'll probably ever get from the UK government to a free lunch. Now, I personally use Trading 212 for my Stocks ISA, and they are currently offering new customers one free fractional share valued up to £100 in order to help you get started when you scan the QR code up here on screen, or click on the link down in the description below and open an account with them. If you've recently opened an account within the past 10 days, you can also use the promo code Mitch when you're in the app and just deposit £1 into your account, and you'll still qualify for that free fractional share, which you might as well take advantage of. Tip number 6 is to automate the decision. Which one of these subscriptions do you have? I bet you have at least one of them, and I want you to start thinking about investing like a subscription. Because if Netflix asked you to transfer the money each month manually, then you'd probably forget to do it. So to remove the admin tasks from your to-do list each month, apps like Trading212 allow you to set up a pie, which is just your portfolio, and then set up an auto-invest feature with an amount and a frequency that you're comfortable with. And if you don't want to do this, then just at least set a calendar reminder at the end of each month. Tip number 7 is learn what an ETF is. The other day, my uncle asked what an ETF was, so this one's for him. An ETF is a basket of hundreds, if not thousands, of different stocks, all in a single investment, that track different stock market indices around the world, like the FTSE 100, the S&P 500, or even the FTSE All World. It allows investors to own a slice of the whole market rather than having to pick individual stocks for their portfolio's gains. They're low cost, they're diversified, and historically speaking, they've outperformed 90% of professional fund managers looking to track and beat their benchmark index. Tip number 8 is don't put all of your eggs in one basket. As a long-time S&P 500 investor, I don't want this next bit to sound hypocritical, but I do want to add in an additional layer of context, if you like, that perhaps isn't necessarily spoken about all too much, given that the S&P 500 has historically been the gold standard or the benchmark index in terms of investment returns for the past 2 decades. The perspective that I want to give here is that the S&P 500, which is just the top 500 companies in the United States of America, hasn't always been the dominant force. In the 2023 Global Investment Returns Yearbook, which is the gold standard of stock market research, there is this chart. It shows how equity markets have changed over time. In the early 1900s, the UK was the biggest, not to be bet against, with London being the financial capital of the world back then. But things did change. America gained momentum, followed by a small spell by Japan, only for America to now regain their crown. What I'm trying to say here is that past performance is no guarantee of future results. We don't know how long America's outperformance is going to last for. It's the very reason why I've got a pot of my money invested in globally diversified funds for that very reason. Tip number 9 is dividends are powerful, so reinvest them. According to Hartford Funds, 85% of the S&P 500's total returns since 1960 came from reinvested dividends and compounding. On a $10,000 investment in the S&P 500 from 1960 to 2024, it would have been worth $6.4 million if you reinvested dividends. But if you didn't, it would be worth just $982,000. And I say just, like, that's still a lot of money, but nonetheless, it would be worth significantly less than if you had reinvested those dividends instead. Now, I will say that this data is probably skewed just a little bit, because if we look at the first 30 years of data that's been provided from this data set, well, dividend yields were actually between 3 and 6% back then. And that's not really reflective of current market conditions. Nonetheless, reinvesting dividends mathematically speeds up that compounding process. And to remove some of the friction from that process, fund managers have been smart over the years, and they've designed 2 specific fund types. You've got accumulation funds and you've got distributing funds. The accumulating one is the one that automatically reinvests dividends so you don't have to. Tip number 10 is the scratch the itch rule. We're all human, right? We've all got that tendency to want to speculate just a little bit and find that one investment that may just outperform the broader market. I've done it myself with crypto, growth stocks. Gosh, I've even got a collection of Pokemon cards, which I probably shouldn't admit to, but it's just me being transparent. And actually, if we look at the data, then actually the returns are pretty wild over the past few years. I allow myself to scratch this itch with no more than 5% of the total value of my investment portfolio, with the other 95% sitting in sensible investments. Tip number 11 is you must beat inflation. This Freddo bar right here cost me a whopping 35 pence, but back in the year 2000, they were just 10p each according to the Freddo index, which I bet you probably didn't expect me to say during this video. But it's also a perfect map of how your money is being eroded over time. Inflation is the official rate that the government give us, but actually, like, real world inflation can sometimes feel typically more than the percentages that are published to us in the press. And the truth behind all of this is that this very chocolate bar didn't become 3 times better or even 3 times bigger, which would have been nice. And in actual fact, it's that your pound became 3 times weaker instead. Right now, UK inflation is 3%. So if your money is earning less than that sat in a savings account somewhere, you're actually becoming poorer and not richer. That's why it's important to invest in assets that outpace the rate of inflation once you've established an emergency fund or a bit of a cash buffer. Tip number 12, don't try and time the market. I wish I had a crystal ball which told me the perfect time to invest each month, but the reality is I don't, so I don't even bother trying to time the market. And actually the market research shows that you probably shouldn't either. Take a look at this from JP Morgan. It shows that if you missed just the 10 best days in the market over 20 years, your returns were cut in half. So staying invested and not jumping in and out of investments is one of the most important factors to your investing success. Tip 13 is unrealized losses are temporary. At points over the last 3 months, my investment portfolio has been down well over £3,000 thanks to Trump and his antics. That's not fun for anybody, but I'm not losing sleep at night because if I zoom out of my investment portfolio, well, over the past 12 months, I'm still up £24,500. In my 9 years of investing, dips in global markets have always been temporary, and those unrealized losses have only become permanent ones if I panic sell. So I haven't done, and when in doubt, I zoom out of my investment portfolio rather than sell out. Tip 14, dead people make the best investors. Yes, you heard me right. A famous study by Fidelity showed that the most successful investors were those who were dead. That's because they're not falling into the traps of chasing trends, jumping in and out of investments, or making emotional decisions. It's important to treat your investment portfolio more like a safety deposit box rather than a slot machine, because the more that you pull the lever, the more likely you are to ruin your investment returns. Tip number 15 is understand your risk tolerance honestly. I've got to be straight with you, investing simply isn't for everybody. Here is the monthly drawdown of the FTSE All World Index. There are some pretty big downturns here, minus 33.8% during the financial crisis, and you have to ask yourself, if your portfolio is down 33%, what would you do? Perhaps a hard question to answer right now with the S&P 500 at all-time highs, but it is an important one to consider because when bad times come around, that's when an individual's risk tolerance truly gets tested. So be honest with yourself, because truly the worst time to find out what your risk tolerance is when your portfolio is already deep in the red. Tip 16 is the 20% rule. This one certainly isn't easy, especially given the current cost of living crisis, but it is one that will move the needle. And that for me was to invest at least 20% of my monthly income every single month without fail. Now, just to be transparent, I didn't wait until I had a super high salary to be able to achieve this. In actual fact, I was doing this when I was earning £28,000 a year. I was living in London in a shared house, paying £900 a month in rent. I paid for all my own food and bills and transport and all of that kind of stuff, yet I was still able to invest £400 a month. It's perhaps harder now than ever before to be able to achieve this, and I want to acknowledge that, but pushing investing up on my financial priority list and then ensuring that there was absolutely minimal financial leakage from my bank account helped me to achieve this. Tip 17 is to stop trying to find the next Nvidia. If you invested £1,000 into Nvidia stock in 1999, well, congratulations, because today you'd be sat on a portfolio worth about 5 million quid. That is why there is a huge gravitational pull, especially for new investors, to try and find what that next hot stock's going to be. But here's the reality. A study from Hendrik Bessenbinder showed that 4% of stocks account for all of the stock market's wealth creation since 1926. The other 96% collectively return nothing more than a treasury bill. So considering there are over 58,000 publicly listed companies available to choose from today, taking the words of wisdom from the late John Bogle, don't look for a needle in a haystack, just buy the haystack. Tip number 18 is don't get FOMO. In 2021, a company called GameStop hit the mainstream media, but for all of the wrong reasons. At the peak of the hype, as a result of a bunch of Reddit users, led by this guy, GameStop stock rose to $80 a share in post-stock split terms. 7,900% increase. But research into attention-induced trading over on Robinhood actually shows that retail investors, when they pile into a stock because of social media hype, then actually their users were forecasted to obtain negative returns. GameStop later crashed 70%, with many investors who bought in during the hype losing a lot of money along the way. So if you're investing out of the fear of missing out, the chances are you've probably already missed the boat. Tip 19 is don't check your portfolio daily. Okay, I'll admit I'm not perfect on this one. Sometimes I can check my portfolio every single day, sometimes multiple times a day, especially when the markets have had a wobble. But checking short-term gains or losses on a long-term portfolio is ultimately pointless. I do try and take the set it and forget it approach, the long-term investing approach to my investments, because that does help me sleep better at night. Tip number 20 is the 24-hour rule. I don't know about you guys, but I get notifications like this every single day on my phone, full of fear-inducing headlines because, let's be honest, fear sells and it gets clicks. But actually the research shows investing on emotion increases the odds of buying high and selling low. The exact opposite of investing wisdom. We see this in the data, where the average investor underperforms the S&P 500 by over 1.2% annually due to the behavior gap. That's potentially tens of thousands, if not hundreds of thousands of pounds lost over the duration of your investing lifetime just from reacting to the news. To combat this, I try and use the 24-hour rule, where I don't do anything to my investment portfolio until at least 24 hours of news has passed. This gives me the space to realize that news cycles change extremely quickly and gives me the headspace to know that my long-term investment thesis is very much still in play. And if anything, following that long-term investment plan actually gives me that little bit more incentive to perhaps invest more when the news is full of fear and actually the markets are perhaps taking a turn for the worse. Tip 21 is understand your why. I've got to be straight with you guys. I'm not investing to buy a Lamborghini, although it would be quite cool. But instead, I'm investing to take back total control of my time. So I can pick my son up from school when he's old enough, or take my wife out for lunch on a random Friday afternoon to start the weekend early, or even just go to the gym on a Tuesday afternoon and not feel guilty for doing so. For me, none of this is really about the materialistic things, and instead it's about living life on my own terms. Running my own business has certainly given me a little more flexibility within my life, but investing will allow me to truly escape that kind of 9 to 5 grind every single week. But look, a lot of savers are still making mistakes with their money in 2026, so to make sure that you're not one of them, make sure you click on that video next, subscribe to the channel whilst you're over here. And with that being said, I'll see you over in the next one.